Okay guys, so in this video we're going to talk a lot about what's going on currently in the market. So in case you guys weren't aware, the S&P 500, the Dow Jones, they both hit all-time highs yesterday, and that was basically back from good vaccine news that maybe by the end of next quarter in 2021 we'll have a vaccine to treat the pandemic. So what you saw happen is basically Dow Jones and a lot of those stocks that got hurt, so of course airline stocks, cruise stocks, restaurant chains, even credit card processing companies. Basically, all the companies that had basically had sold off due to the whole pandemic, those stocks went through the roof. But on the other hand, we saw a lot of the stay-home stocks like Zoom, Netflix, and all these other stocks got crushed. So as you can see here, the S&P, this is SPY, this is ETF for the S&P 500. That stock was at an all-time high. But one of the probably the best stay-at-home stock that's probably on the market in general is Zoom. And as you can see here, Zoom got crushed. So basically, why I'm recording this video is I want to talk a little bit about what I think is going to transpire throughout the rest of the year and why I wouldn't really rush to sell some of these stay-at-home stocks yet. And I want to talk a little bit more about what to do, whether, a lot of people I've been reading on forums like Fidelity forums and other people, and a lot of people are thinking, okay, the market's at an all-time high. Should I go cash? Will there be another crash? And I want to talk a little bit about why I think going to cash, you could miss the next run-up in the market. So let's get right into it, guys. If you enjoyed this content, please be sure to give me a big thumbs up. It really helps out. So first thing I want to talk about is whether the stock market is overvalued or not. So obviously markets are at an all-time high, but how do I actually figure out how the stocks are valued in relation to the GDP? In other words, if stock prices are really high, what is that in relation to the economy? Because, a lot of people see stocks as just, a flashing ticker symbol like, oh, it's 45 one day and next day it's 35. But in reality, it's just basically technology tracking shares in a real life business. So if businesses are doing better, then stocks will do better over time. So the only way that I've found, in all my years of investing to kind of track this is using something called the Buffett Indicator. So what the Buffett Indicator is, basically takes the total stock market cap and divides it by the GDP. So according to the Buffett Indicator, and this was kind of coined by Warren Buffett, it's a way he values stock market. The stock market is pretty overvalued. So now it's at 173%. You guys can check this out if you go to Guru Focus and go type stock market valuations, or you can just go to Google and just type in Buffett ratio. That's the easiest way I find it. So as you can see here, taking a look at the chart, it shows that stocks are grossly overvalued. And as you can see here, the prices of stocks are kind of getting out of line with the U.S. economy. Now, obviously, this isn't 100% accurate because, obviously a lot of companies do business overseas and the Buffett ratio doesn't really include those foreign GDPs. But I usually use this as a rough number because usually it's pretty accurate. So right now, this would be a good time, I think, if you're really up a ton on some of these positions. It's okay to take a haircut. And when I talk about this in some previous videos, it's simply you're just trimming the position a little bit and you're kind of reinvesting into some of those stocks that have been beaten down. So what kind of stocks would I give you guys? Some stocks that I think are an excellent opportunity in this type of market environment. And then I want to talk a little bit more about why I think selling everything and going to cash could be a critical mistake. So one of the stocks that I think is really going to benefit, obviously, from things reopening, and this is kind of an entire sector of stocks, are REITs, real estate investment trusts. So basically, with the pandemic, a lot of people aren't going outside. This has absolutely crushed REITs because REITs, whether they're apartment REITs, commercial space REITs, or even, REITs for commercial space apartment REITs, are REITs for, other things such as malls. That's what I'm talking about. Malls. These have been hit some of the hardest by the pandemic because without the foot traffic and people using it, a lot of the tenants haven't been able to pay their leases. So, okay, so here's a long-term chart of the Nasdaq. So as you can see here, back there was the dot-com bust, then it crashed, came back, and then we had the 2008 financial collapse. It went down, and it came back. So, if you panicked here, if you said, oh, stocks are a scam, things like that, and you got out of it, you missed a lot of gains. You missed a lot of companies like Amazon. You missed a lot of companies like Apple. You missed a lot of companies like Netflix. And obviously, as you guys aren't familiar, markets tend to go up over the long term. Being in stocks is the best possible way that you can grow basically your capital. Now, obviously, you have stuff like gold and real estate, and those are kind of God's assets, and those assets should definitely be a part of your portfolio. If you don't have real estate, you can get involved in REITs, and if you you should always own some physical gold or bullion somewhere. Guys, you can buy from JM Bullion or AppMax. But other than those two other assets, I would say, and of course Bitcoin now, a lot of people are on Bitcoin, which I'm going to talk about later. But, you know, stocks is going to be your best bet. So I want to show you guys a picture of the return on stocks versus other asset classes over the. Okay, so shout out to Brian Ferraldi. I hope I'm pronouncing that right, from thefool.com. I follow him on Twitter, and this is where I got this chart. So what does this chart say? Well, this is the total real returns on U.S. stocks, bonds, bills, gold, and the dollar from 1802 to 2012. So why am I showing you this, guys? Well, I want you guys to take a look at these numbers. So just to say like 200 years, you know, give or take a couple decades, let's say 200 plus years, stocks have returned 6%, bonds 3%, treasury bills 2%, gold just under 1%, and the dollar's lost value. So if you had $1 in 1802 and then you invested in stocks, that dollar now would be worth, according, you know, as of 2012, probably obviously more now since markets are up, but let's just say that dollar would be worth north over $700,000. If you had just kept the dollar and didn't invest anything, it's worth now 5 cents. Gold went up like 4 times. Treasury bills went up over 200 and sometimes. Bonds went up there. So what does that mean? Well, I think it's really crazy to take all of your stocks and move to cash, knowing that the dollar is losing value over time, and knowing that with a Biden presidency, we're going to see a massive stimulus package. So what sense does it make to just dump all of your stocks? Obviously, you want to trim some of the positions you're up, but to get out of the market altogether, it's bad for a couple of reasons. So like one of the biggest reasons is simply because tax purposes. If you own a stock for less than 12 months, you're going to be charged a short-term capital gains tax. You don't want that. You don't want to increase your tax bill if you're up a ton on your positions because you're trading in and out of stocks, and you're going to have to pay more taxes. It's better to hold your stocks at least a year so that now you're a long-term capital gains tax. That's the first reason, taxes, just better. The second reason is if you really have to sell some stocks, I wouldn't just go sit on cash altogether because you're missing out on dividend growth. So what I'm personally doing with my portfolio is I'm looking at a lot of the positions that I'm up on, and I'm looking to move that money into dividend stocks, because dividend stocks are not going to fall as far because of that passive income. A lot of people are holding on to those shares just to get the dividend, whereas these non-dividend paying stocks, they have a lot further to go. And the third reason I don't is because I don't like to let fear control my behavior in the stock market. If you're going into all cash, you're trying to time the markets. And it's impossible to do that. We don't know how successful this vaccine is going to be. We don't exactly know what Joe Biden is going to do. We don't know. So if you're selling out right now, assuming that, okay, now's the time to get out, the markets will crash much lower. If they release a stimulus package that's going to devalue the dollar more, stocks are going to shoot much further because, hey, let's say the stimulus package is a couple $1 trillion. Well, a lot of that money is going to end up back into the market, and the majority of the U.S. economy is spending. So a lot of that money is going to pump right back, and a lot of these companies are going to see much higher all-time highs. And probably the fourth reason is for like a psychological reason. Trying to get in and out of the market time is very stressful. And investing in stocks should be fun. It shouldn't be something that stresses you out. It shouldn't be something that keeps you up at night worrying. You know, my advice would be the simplest way. If you're really worried about stocks crashing and things like that, try moving in to consistent dividend paying stocks. These stocks, they don't have as much, you know, short-term gains, but they don't have as much short-term losses. Start picking more dividend stocks. That's always what I do. When the market's up, when the markets are all-time high, I move more into dividend stocks because I can sleep better at night. I know I'm getting that income on my portfolio, and I know that dividend stocks are going to crash. Apple is not crashing. You know what I mean? It'll come down in price, but it's not going to crash. Walmart's not going to crash. You know, Microsoft won't crash, but other stocks, Tesla, could crash. Netflix could crash. So I would just try moving some of that money, stay in the market, don't just go too much in cash, and kind of just see what happens, because as you can see here over the years, there's a lot of dips down if you take a look at this chart, but the long-term position is up. So don't make the mistake I did 10 years ago. I got scared out of the market, and it took me a couple years to really get back in, and I missed out on a lot of gains. So for you guys that didn't weren't investing during the whole 2008 financial collapse and things like that, my best advice would be stick with it. If you're really worried about your portfolio, move into some lower volatile dividend stocks and ride out this wave, because it's going to be exciting. Next year, hopefully we'll start getting things back to the way they were. People will start going outside again, and a lot of these companies are going to hit record revenue. They've already hit record revenue during probably the worst pandemic that I've ever experienced in my lifetime for a lot of you guys. So things are only going to get better from here. So I would just say stick with it, stay positive, and everything will be fine. So that's it, guys. I hope I answered a lot of questions that have been coming up. I've been reading a lot of your responses and reading a lot of articles on the internet. So I hope I explained. If you guys have any more questions, be sure to leave them in the comments. Do my best to give you guys my opinion. So that's it until next time, guys. So if you really enjoyed this video, please smash the red subscribe button. It really, really helps. Until next time, guys, take care.